Hello Lana, welcome to Manifested e-learning forum. My name is Emlyn Gwiri. I'll be taking you through equity investment analysis. The topic that we'll be looking at today is private company valuation. In this lesson, this is the second lesson that we will be looking at private company valuation, and we'll build on the concept that we've actually learned in lesson 1. So we are looking at private company valuation. Now, what we will be looking at under this topic review include 1. Definitions of value. Definitions of value there. And now, more specifically, we'll be looking at the fair market value. Fair market value. Then we will look at the market value. Market value itself. Value there. Then we will move ahead and look at the investment value. Investment value there. And then we will conclude by looking at the intrinsic value. What is the intrinsic value there? Now, those are some of the key definitions that need to be understood before we go ahead and conduct private company valuation. Now, once we look at this, then we will go ahead and move on and look at something else, including the approaches to private company valuation. Approaches to private company valuation. There. Now, under the approaches to private company valuation, we have 3 approaches. The first approach is the income approach to private company valuation. Then we will move ahead and look at the market-based approach. Then we'll continue and look at the asset-based approach. Asset approach to private company valuation there. Moving on, we will now move ahead and try and look at normalized earnings. We'll try and see how we can be able to adjust the earnings for private companies based on cyclicality. So we will be able to conclude this lesson by looking at normalized earnings. Like that. So this normalized earnings concept was also done in private in the previous topic which you had looked at, which includes the market-based valuation, price and enterprise value multiples, where we were able to adjust for cyclicality based on the information given. So to start off, we look at the definitions of value. Definitions of value. There. Now, the first definition we'll be looking at, or the first component of definition we'll be looking at, is the fair market value. So we say fair market value. There. Now, under the fair market value, we need to understand one thing. It is based on the concept of willing buyer, willing seller. So, fair market value, we can shortly put it like so and say that it is the market value based on a willing and able buyer, on a willing and able buyer transacting with a willing and able seller. Putting this into perspective, I can say that if I am a buyer of this marker pen right here, it is based on the concept that how much am I willing to pay so that I can be able to acquire this marker from a given seller there. That is what I'm trying to stress out over here. Fair market value is the market value based on how much I am willing to pay for this marker pen and how much the seller is willing to accept to sell this marker pen to me. That is what you're saying is the fair market value. Now, in the securities industry, the fair market value is based simply on the same principle of willing buyer, willing seller. How much low is the seller willing to come down so that they can be able to sell securities, and how much high can the buyer buy those securities that they intend to purchase. That is what you're saying is the fair market value. Now, moving on, we look at the market value there. So market value. Now, this market value, we can put it like so and say that it is the value of an asset based, this should be based on, number one, willing and able buyer stroke seller interacting with each other. And number two, which is very key, the asset has been marketed. The asset has been marketed. There. Now, trying to link those two together, we can say that it is applicable within the real estate sector. It is the value based on, number one, the willing and able buyer or seller. It is based on the fact that the asset has been marketed or has been sold. We can say this concept has been used in the real estate sector in order to determine the price of an asset, There. So that is the market value. It's based on these two characteristics, willing and able buyer and seller, which you had already mentioned here in fair market value, and it is also based on the fact that the asset has been marketed there. Now, moving on this side, we look at the investment value. Now, the investment value, we are saying, will focus on the concept of perceived synergies. The concept of perceived synergies, if I can be able to put it into perspective like so, using an example over here, we can say that is, say, a company that deals with tires. It has an intention of acquiring this company over here, which also deals with tires like that. Now, the value or the price that this company pays to acquire this other one is what we are saying is investment value. This company deals with tires. Probably it might be good in engineering. It is probably good in engineering, and we are saying that it is being good in engineering. This one could be good in research. It could be good in research and development. There. Now, merging those two companies will produce an output as follows. 1 plus 1 should be equals to 5. The two firms combined should have an output level, or the output should be much more. The benefit should be much more than the two individual companies remaining individually or separate like that. That is what you're saying is the concept of synergy. So we can put this in writing and say that it is the value. It is the value of an asset based on the perceived synergies that are to be realized. That. So already explained it using the two forms over here. Putting it like that simply is that the amount of money that this company has spent to acquire this one should produce a benefit that is much more than that firm remaining separate and this other firm also remaining separate like that. That's what I mean about the perceived synergies like that. Now, having looked at the synergies, let's move ahead and look at the intrinsic value. Intrinsic value. The intrinsic value is the value of an asset that an investor, or rather an analyst, believes that the value of an asset should actually be. And it is the intrinsic value that analysts use to try and compare with the market price so that they can be able to determine if a share is undervalued, correctly valued, or overvalued there. So we say something about the intrinsic value. It is the value of an asset. We can say it is the value. It is the value of an asset based on a hypothetical complete understanding on a hypothetical. Apologies. On a hypothetical complete understanding of the asset's investment characteristics, understanding of the assets complete investment characteristics that. So we're saying the intrinsic value is the value that the analysts usually use to try and compare with the current market price so that they can be able to determine the true and fair value of an asset. It is, you can continue, it is the true and fair value of an asset. That. So we are saying the intrinsic value if the current market price is greater than the intrinsic the asset is overvalued. That is what you're saying is the intrinsic value. And those are the key definitions of value that we need to understand before we perform private company valuation. Now, looking at our summary here, that as our guide, we've looked at the definitions of value right there. Now we need to move on and look at the approaches to private company valuation, their private company valuation. So the approaches to private company valuation include the income approach, the asset-based approach, and the market approach. So we start approaches to private Company Valuation. Now, the first approach is what we're saying, the income approach. And under the income approach, it is based on the value as if an asset, or it is the value of a private company based on the present value of the firm's expected future residual income. So we are saying that if we expect cash flows to receive 1, 2, 3, 4 like that in future, the income approach values the private company based on the present value of expected future expected cash flows or future cash flows there. So we can say that we need to now discount. These are the projected revenues. Now we need to discount them back to year 0 over here so that we can be able to actually see the value of those cash flows today. So that at the end of year 1, 2, 3, 4, we will be able to expect some growth factor to have actually been considered when trying to determine the value of private companies there. So you can say this, that it is the valuation approach based on the present value of the firm's expected future income. Present value of the firm's expected future income. Now this approach is usually useful and it is almost similar to the free cash flow valuation approach, and we will be able to demonstrate this probably in our next lesson, how we can be able to determine the value of a private company using this approach. Number 2 is we are saying we are looking at the market-based approach. Market-based approach. Now, under the market-based approach, it values a firm using price multiples. If you recall, in market-based valuation, price and enterprise value multiples, we had looked at the price to earnings ratio, price to book value ratio, and price to sales ratio, amongst other ratios. Including the justified ratios, we had actually tried to focus on those multiples when we were looking at market-based valuation, price and enterprise value multiples, including the enterprise value to EBITDA multiple. If you recall, you should be able to go and look at that lecture so that we can be able to try to understand. So you can be able to just try and look at market-based valuation multiples so that you can be able to just try to understand how this is done. But for here now, we will just be able to provide some clear guide on how the market-based approach is applicable. So we can say under the market-based approach, it values a firm, we can say using price multiples, and these price multiples are based on comparable sales data, which are based on comparable sales data stroke information. Yeah. So we are here, we'll be looking at ratios over here where we're saying we'll be looking at the market value of invested capital to EBITDA multiple. So we're saying we'll be using MVIC to EBITDA multiple as a key highlight there, where we are saying it is going to be based on market value of invested capital to EBITDA multiple right there. So that is the market-based approach. Now moving on, let's look at the asset approach. The asset approach is just based on the value of the assets minus the value of the liabilities. Now let's look at it on this side here. Value of the assets minus the liabilities is what you're saying is asset approach. Asset approach. It values and affirms assets minus liabilities so as to get the value of private company. There. Now, having looked at the three main approaches that are used in determining the value of private companies, now we will end this lecture by looking at the normalized earnings. Now, normalized earnings, I had explained it under market-based valuation, price and enterprise value multiples, and I had said this. I said that normalized earnings is trying to adjust the company's earnings for cyclicality changes. So we can say that the normalized earnings we can say it is the process of getting the firm's earnings and deducting non-recurring components. That is what we had looked at under market-based valuation, price and enterprise value multiples. Then we said that the non-recurring earnings include gains on asset sales, asset write-downs, and also changes in accounting estimates needed to be deducted from the earnings so that you can be able to arrive at the normalized earnings. In private company valuation, the issue of control, remember we had looked at the concentration of control under the differences between private companies and public companies, and I had mentioned the concentration of control for private companies is concentrated within a few individuals. Most probably the management team is also part of the board of directors or the ownership of the company there. So here, concentration of control needs to be considered for tax purposes, and that is a key item that needs to be deducted so that you can be able to arrive at the normalized earnings. Probably the best way to explain the normalized earnings is to use an example so that we can be able to highlight the key changes that are needed there. So the example reads as follows. Tom is a principal shareholder, CEO, and founder of A Generators. A reports the following. Number one, Tom's compensation for 2.5 million is included in the firm's selling, general, and administrative expenses. Number two, A leaves a warehouse for 100,000 a year from one of its largest suppliers. A owns a vacant office building with reported SG&A expenses of 150,000 and 25,000 of depreciation expense. What I mean by SG&A expenses is the selling, general, and administrative expenses, so we need to take note of that. Number four, A's capital structure has too little leverage. An analyst determines a market-based compensation figure for Tom's position is 1 million and that the office building is not needed for core operations. The market lease rate of the warehouse is 130,000. Based on points number 1 to 4 above, what adjustments should the analyst make to A's reported income in order to estimate normalized earnings, assuming the firm will be acquired. So we are saying we need to make some adjustments to that, to those 4 statements, so that we can be able to normalize the earnings of the company. And one of the things that we need to look at is that we need to identify what is the market providing in terms of the compensation values there. So we are saying, for example, that in point number 1, we have a difference of 1.5 million there. So we can see that the SG&A expenses based on the compensation figure is 2.5. Now Tom is earning 2,500,000, like that. And that compensation is reported in the selling, general and administrative expenses. Now this 2.5 million compared on the market, or the market levels are providing what? We are saying down there that an analyst determines that the market-based compensation figure for Tom's position is 1 million. So we are saying that the market is giving over here 1 million. That is the industry average. So what we need to do is that the adjustment over here is that we need to remove this salary from SG&A expenses by how much? We reduce it so that it can be similar to the market levels, like that. So if you wish, probably I could just explain it like so. Let me put it like so that we can be able to understand clearly. So this is Tom there. Here is the based on the SG&A expenses, Tom SG&A based on salaries. We are saying it is getting 2,500,000, like that. And then you're saying the market level is 1 million market. This is A. This is company A, yes, and this is 1 million. Like that. So we are saying that we need to reduce this SG&A expenses by 1.5. Adjustment. We need to reduce by 1,500,000, like that. So we need to reduce this by 1.5 million so that it can be similar to the market. That is what you're saying is normalizing the earnings, ensuring that the levels of the company are similar to that of the industry average there. So we're reducing this by 1.5 so that you can be able to get that market level to be the same, or to normalize the earnings. So we can be able to put it like this. Instead of squeezing ourselves over there, we can say that adjust in point number 1, we can say right over here, reduce the SG&A, selling, general administrative expenses, by 1,500,000. And how did we get 1,500,000? We can say it is 2,500,000 minus 1 million, like that. That's how we got the adjustment. Number 2, A leases a warehouse for 100,000. We are saying the lease for A is how much? A leases a warehouse of 100,000 per year, 100,000, like that. And based on the information down below over there, we are saying that the market lease rate for the warehouse is 130,000. So we're saying 130,000 is the market lease rate. Now we are trying to adjust A to be similar to the market. So we are saying that the adjustment for number 2 over here will be add. The difference between this is 30,000. Add 30,000. So 130,000 rather. 100,000 minus 130,000. So we're saying add 30,000 to the lease rate to normalize the earnings. To normalize the earnings. That. Now, based on point number 3, A owns a vacant office building with reported SG&A expenses of 150,000 and 25,000 of depreciation expense. So we are saying depreciation, we can combine it, office building expenses, SG&A expenses, SG&A expenses there, and also depreciation. For A, we've been told based on the SG&A expenses, it is 150,000. And we've also been informed that it's 25,000 for depreciation. That. We haven't been given any information in this regard, for the regard of these two, so that we can be able to try and normalize the earnings. That means what? Here we have 0 and here we have 0 there. So what should we do so that we can be able to reduce it over here, so that we can be able to make sure that it's similar to the market levels? We should say, number 3, reduce. We can combine them, SG&A expenses and depreciation by 150,000 that and 25,000 that. So we are trying to make this to normalize the earnings, to reduce it to 0. So we have to reduce it by 150,000. We have to reduce this by 25,000. Now on this other side, we can be able to summarize point number 4, which says that A's capital structure has too little leverage. If it has too little leverage, it means that the component of debt will not form any critical part or component within the analysis of trying to normalize the earnings. So here we will not do any adjustment because the debt component is very insignificant there. And that brings us to the end of this second lesson, which deals with private company valuation. We hope that you'll join us in our next lesson. Thank you and God bless you.
Thank you for watching this video. Don't forget to get yourself a copy of our professionally prepared study text and revision partners. Visit our shop along Tom Boyer Street, Pioneer House, 3rd floor, opposite Fire Station.